Florida's condo market crash in 2026 isn't just cooling down. It's reshaping the Florida housing market and real estate trends. It's breaking wide open across real estate. Across cities, prices aren't dipping 5 or 10% anymore. They're falling 25, 30, even more than 30% from peaks that felt untouchable just a couple of years ago. Owners who bought near the top are seeing statements showing their equity gone. Retirees who thought they had secured a calm, predictable lifestyle are being hit with exploding insurance bills, 4- and 5-figure special assessments, and monthly costs that climb no matter what the market does. Inventory is swelling, with for sale signs lingering for months. HOA fees rise to cover repairs, new rules, and insurance shocks. In many buildings, the cost of holding a unit is higher than what that unit can earn in rent. What was sold as the Florida condo dream has turned into a stress test of how much pain ordinary people can carry. This is Housing Watch Channel. If you want honest, cinematic breakdowns of the housing markets quietly breaking before the headlines catch up, subscribe now. Today, we are counting down 10 Florida cities where the housing condo market is in serious trouble in 2026. Stay with us through number 1, because the last city was once marketed as one of the safest bets in the state. Now, the numbers and the lived experience tell a very different story. Before we get started, make sure you're subscribed to Housing Watch and turn on notifications so you don't miss what's coming next. Subscribe for clear, data-driven insight into housing market. Your support really helps the channel grow. Tap like, share your local experience in the comments, and buckle up. Now, start the engine. We have a lot of miles to cover. Let us begin. Number 10. Bradenton. The Bradenton condo market in 2026 is drawing attention in Florida housing market forecasts as another signal of the broader Florida real estate slowdown. Just north of Sarasota, Bradenton once thrived on a simple appeal: slightly lower prices, less spotlight, and many of the same Gulf Coast benefits. That positioning made it feel like the affordable version of the Florida coastal dream. In 2026, that affordability is being tested. Typical condo prices that climbed near $400,000 during the boom have fallen below $280,000, marking roughly a 30% drop. Listing inventory has surged, with recent counts showing more than 1,500 condos on the market, far higher than just a few years ago. The growing supply is reshaping Bradenton real estate trends and pushing sellers into deeper price cuts. The bigger issue is rising ownership costs. HOA dues that once averaged $300 to $400 monthly now often range between $500 and $900. Insurance premiums that used to sit around $2,800 annually are now closer to $7,000 or more. Combined with mortgage rates near 7%, many buyers face total monthly costs exceeding $2,200, making renting a more attractive option. Investors are feeling the pressure first. Short-term rental returns have weakened as occupancy dips into the 50% range and nightly rates soften. Some pre-construction buyers from the 2021 to 2022 boom are even walking away from deposits rather than closing on units that no longer generate positive cash flow. Buyer migration trends are shifting as well. Retirees comparing Florida living costs with markets like the Carolinas or Tennessee are finding the sunshine premium harder to justify. The result is mounting inventory, stalled flips, and slower new development. Bradenton's 2026 housing story highlights a simple reality. When insurance, HOA fees, and interest rates rise together, affordability alone can't hold the market up. Number 9. Sarasota. The Sarasota condo market in 2026 is becoming a major talking point in Florida real estate news, and it reflects broader trends in the Florida housing market crash. Once a Gulf Coast showcase known for white sand beaches, a thriving arts scene, and luxury waterfront towers, Sarasota was long marketed as a safe real estate investment. Buyers were told prices would always rise. Now, the numbers tell a very different story. Condos that sold for around $600,000 in 2022 are struggling to fetch $420,000 in 2026, marking roughly a 30% price drop. Listing inventory has surged, with some estimates showing more than 60% more units for sale compared to the height of the boom. This growing supply is reshaping Sarasota real estate trends and weakening seller leverage. Rising ownership costs are accelerating the shift. Insurance premiums that once hovered near $3,000 annually are now closer to $9,000. New structural safety laws and reserve requirements have pushed HOA fees into the four-figure range, with many owners paying over $1,200 monthly before mortgage or property taxes. Special assessments add more pressure, often ranging from $20,000 to $50,000 per unit for repairs and compliance upgrades. Investors are also stepping back. Rental yields that once approached 7% have dropped closer to 3% after factoring in higher insurance, HOA fees, and vacancies. Even short-term rental income has softened as supply outpaces demand during peak seasons. The emotional shift is just as striking. Realtors report fewer showings, developers are offering incentives, and lenders are tightening financing on older buildings. Sarasota still has its beaches and culture, but the belief that condo prices only rise is fading fast in 2026. Number 8. Orlando. The Orlando condo market in 2026 is drawing attention in Florida real estate news as a cautionary tale for investors and buyers. Known as the tourism capital, Orlando was long seen as a safe, income-driven market. Theme parks, conventions, and steady visitor traffic made condos appear like reliable cash flow properties. That reputation is now under pressure. During the pandemic boom, condo prices near downtown and key resort corridors climbed toward $310,000. Today, many of those same units sell closer to $230,000, a roughly 25% drop from peak values. Active listings have nearly doubled, leaving thousands of condos unsold across the metro area. Carrying costs have escalated sharply. HOA fees in many buildings now range from $600 to $1,000 per month, and insurance premiums have roughly doubled since 2021. That means a two-bedroom unit that once cost around $1,800 monthly to carry can now exceed $2,600 when mortgage, taxes, insurance, and HOA dues are combined. Short-term rental demand has not saved the math. Complexes near International Drive and other tourist corridors are crowded with units competing for the same shrinking pool of travelers. Occupancy rates in some buildings barely reach 50%, and nightly rates are under pressure. Florida's new structural inspection and reserve laws add further strain, with older units facing $10,000 to $20,000 special assessments. Lenders are stepping back, making financing more difficult, and even cash buyers demand steep discounts to offset perceived risk. On the ground, the mood has shifted. Streets once lined with sold signs now display long rows of for sale listings that stagnate. Owners who assumed they could always pivot to short-term rentals are discovering the numbers no longer automatically work. Orlando's 2026 condo market proves that tourism is powerful, but it's not magic. When ownership costs outpace local incomes and rental yields simultaneously, even the theme park capital has to respect the budget. Number 7. Daytona Beach. The Daytona Beach condo market in 2026 is making waves in Florida real estate news, highlighting key trends in the Atlantic coast housing slowdown. Known for its oceanfront towers, spring break crowds, and affordable beachside living, Daytona once branded itself as the budget-friendly Florida coastal alternative, offering middle-class buyers a slice of sunshine without South Florida prices. In 2026, that story is under serious pressure. During the boom, many Daytona condos climbed into the low $200,000 as investors and second-home buyers poured in. Today, similar units trade closer to $160,000 to $170,000, roughly 20 to 30% below peak values. Listings have multiplied, and in several complexes, identical floor plans now compete for the same limited pool of buyers. The real challenge is in monthly carrying costs. Insurance that once ran about $2,000 per year can now double in older towers near the water. HOA dues that previously felt manageable often land between $500 and $900 after boards raise fees to comply with new inspections and build reserves. Special assessments for concrete repairs and structural fixes add further pressure. Snowbirds and retirees on fixed incomes feel the strain. Some tighten every other expense just to stay current, while others sell below what they paid to avoid the next round of charges. Associations juggle delinquencies while trying to satisfy contractors and insurers. Investors face tighter margins as well. Daytona's short-term rental market is crowded with condos competing against hotels and other beachfront units. Occupancy rates have slipped, nightly rates are under pressure, and long-term rents rarely cover insurance, HOA fees, and taxes. Walk the beach, and the change is visible. Buildings once selling quickly now sit with multiple for sale signs, fall out of contract, and relist repeatedly. Daytona Beach still has the ocean, the speedway, and tourist appeal, but it no longer has a condo market where those attractions alone guarantee profitability. Rising costs and market saturation are rewriting the rules in 2026 Florida real estate. Number 6. Jacksonville. The Jacksonville condo market in 2026 is emerging as a critical story in Florida real estate news, highlighting how even traditionally stable markets are feeling pressure. Located on Florida's northeast coast, Jacksonville long earned a reputation as the steady one, offering a large land area, a growing metro, a diverse job base, and a lower cost of living than South Florida. That made it attractive to both locals and out-of-state investors seeking a safer Florida real estate bet. Now, that narrative is shifting. Median condo prices that hovered near $230,000 during the recent peak have dropped to around $180,000, a decline of more than 20%. Listing inventory has surged, with roughly 60% more condos on the market than during the boom years, creating a buyer-favorable environment. Ownership costs are driving the crunch. HOA dues of about $400 per month and annual insurance bills near $4,000, combined with higher mortgage rates, push typical monthly expenses toward $1,700. Average rents for comparable units sit closer to $1,400, leaving a widening gap that discourages both investors and owner-occupants. Out-of-state buyers who fueled the previous upswing are now trying to exit, with more than a third of active listings in key neighborhoods showing price reductions. Downtown and riverfront condo projects, once seen as anchors for urban revival, are offering incentives and concessions to maintain occupancy. The pace of change is striking. Jacksonville, long marketed as a calm, upward trending market, is now facing volatility similar to South Florida and the Gulf Coast. Higher interest rates, insurance shocks, and stricter underwriting on older buildings are reshaping buyer behavior. Today, buyers ask about reserves, inspection history, and insurance costs before even considering square footage. Jacksonville remains a major Florida city with real economic strengths, but the myth that it was immune to the 2026 condo crunch has officially been broken. Number 5. Cape Coral. The Cape Coral condo market in 2026 is making headlines in Florida real estate news as a cautionary tale for waterfront buyers and investors. Known for its iconic canals, boat docks, and stunning sunsets, Cape Coral once embodied the Florida dream of easy appreciation and lifestyle luxury. Today, that dream is under serious pressure. Median condo prices that peaked near $340,000 have fallen toward $240,000, a roughly 30% drop. Inventory has nearly doubled, with new listings far outpacing sales, and creating a buyer's market in a region that once saw units disappear quickly. Insurance costs are at the center of the story. Premiums for many waterfront condos have skyrocketed from around $3,500 in 2020 to $10,000 or more in 2026. HOA fees ranging from $600 to $900 per month are now standard, and special assessments for flood mitigation, roof repairs, and structural upgrades often add $20,000 to $30,000 per unit. Retirees who purchased in cash are facing monthly costs that rival or even exceed a typical mortgage payment. Investors relying on vacation rental income are being squeezed as occupancy dips below 45% in some complexes, leaving total monthly revenue far below projections. The lingering effects of Hurricane Ian and updated flood maps have made buyers more cautious. Properties in higher-risk zones or older buildings often attract few serious offers, even with price reductions. Some insurance companies have exited the market, leaving owners dependent on costly state-backed coverage. The visual change is dramatic. Canals that once saw listings vanish in days now overlook rows of 4 or more for sale signs. Developers who raced to build during the boom are now balancing partially finished projects with buyers demanding renegotiations. Cape Coral is far from empty, but the vibe has shifted. The narrative has moved from easy appreciation to hard conversations about climate risk, insurance shock, and the real cost of waterfront living in 2026. Number 4. Tampa. The Tampa condo market in 2026 is a major story in Florida real estate news, highlighting how rapid growth and luxury demand are colliding with rising costs and market corrections. Tampa's skyline still features cranes, high-rises, and waterfront views, a symbol of past momentum, but the condo market tells a far more complex story. Median condo prices have fallen from around $310,000 to roughly $230,000, a decline of about 25% from peak values. Along Bayshore Boulevard and other prime corridors, units that once sold near $600,000 now struggle to command $400,000. Total inventory has surged, with thousands of active listings, the largest number since the last major downturn, creating stiff competition for sellers. Carrying costs are climbing fast. HOA fees in many towers have risen from $450 to $1,000 per month, while insurance near the Bay has roughly tripled to nearly $9,500 annually in some properties. A typical buyer with a standard mortgage now faces monthly ownership costs exceeding $2,400, a heavy burden in a metro where median household income hovers near $70,000. short-term rental income, once a buffer for owners, is softening. Many Tampa buildings report Airbnb occupancy below 50%, with nightly rates declining under competitive pressure. Nearly 40% of condo listings in some neighborhoods have recorded price reductions. Psychology is now as important as supply and demand. Tampa's post-pandemic boom drew remote workers and out-of-state buyers seeking opportunity, creating a narrative of unstoppable growth. In 2026, that confidence has frayed. Construction timelines are delayed as developers adjust for higher insurance, financing costs, and slower pre-sales. Flood zone reclassifications, stricter inspections, and tighter lending criteria leave buyers questioning whether they are stepping into a stable investment or a moving target. Tampa still offers jobs and growth, but the condo market can no longer ignore the basic math of affordability. Rising ownership costs, insurance shocks, and market saturation are reshaping expectations for buyers and investors alike in 2026. Number 3. West Palm Beach. The West Palm Beach condo market in 2026 is becoming a major focus in Florida real estate news as luxury pricing and rising ownership costs collide. Once marketed proudly as the new Miami, this coastal city attracted wealthy buyers with sleek towers, luxury branding, and promises of sky-high returns. Today, that narrative is under strain. Median condo values that topped $400,000 in 2022 have fallen to around $300,000, a drop of roughly 25%. In some high-end buildings, individual units have experienced even steeper declines from peak listing prices. Meanwhile, ownership costs have surged. Insurance premiums in coastal towers have tripled, reaching $12,000 annually or more, while HOA fees have doubled to $1,000 per month. Surprise assessments of $30,000 to $40,000 per unit are increasingly common as boards scramble to comply with new state regulations and address deferred maintenance. Short-term rental income is no longer a reliable buffer. Occupancy rates in many luxury towers have fallen below 50%, and nightly rates are softening under increased competition. Lenders are cautious, often restricting financing in buildings with maintenance backlogs, thin reserves, or high investor concentration. The change is visible. Buildings that once lit up the skyline with fully occupied units now show stretches of dark balconies. Wealthy buyers are negotiating offers 20% below asking and seeing them accepted. International investment that once fueled Palm Beach County is shifting toward newer developments with stronger engineering, better insurance coverage, or entirely different states. Longtime residents feel the impact. What was promised as protection through fees and upgrades now feels like a trap between unmanageable bills and resale markets that cannot support peak prices. West Palm Beach retains its prestige, but the assumption that top-tier buyers will always pay whatever it costs is no longer guaranteed. Rising insurance, HOA fees, and market corrections are rewriting the luxury condo story in 2026. Number 2. Aventura. The Aventura condo market in 2026 is a major story in Florida real estate news, showing how rising costs and market corrections are reshaping even luxury markets. Just north of Miami, Aventura built its reputation on high-end, low-drama condo living. Water views, upscale shopping, gated security, and a steady stream of international and out-of-state buyers gave it an aura of safety. That perception, however, has dimmed in 2026. Condo prices that peaked near $600,000 in 2022 have fallen to around $440,000, a drop of roughly 27%. Listing inventory has surged by about 80%, with both older waterfront towers and newer mid-rise buildings seeing units sit on the market for months. Rising ownership costs are driving much of the pressure. Insurance premiums across coastal Broward and northern Miami-Dade have roughly tripled since 2020, often topping $12,000 annually for waterfront buildings. HOA fees at many luxury properties now exceed $1,200 per month. New reserve rules are triggering additional special assessments, commonly $25,000 to $60,000 per unit, particularly in towers built decades ago. Out-of-state buyers from New York, Latin America, and Europe, who once viewed Aventura as a safe haven, are now recalculating. When all-in expenses exceed what a unit can reasonably earn in rent, that safe haven starts to feel like a liability. Short-term investors relying on seasonal rental income face similar challenges. Softening demand, tighter city regulations, and increased competition have pushed occupancy below 50% in some buildings, while nightly rates continue to decline. Developers who once marketed South Florida stability are now offering incentives such as closing credits, HOA buy-downs, and flexible terms to move remaining units. Agents report slower negotiations and more cautious buyers, with the assumption of automatic appreciation gone. Aventura remains wealthy, visually impressive, and desirable. But 2026 has made one thing clear: even luxury enclaves are not immune. Rising insurance costs, special assessments, and falling rental yields can shake the foundation of any high-end condo market. Number 1. Pensacola. Topping our list of Florida's most challenged condo markets in 2026 is Pensacola, long promoted as the attainable version of the Florida dream. With Gulf views, a strong military presence, and small city charm, it once looked like a safer, more affordable coastal option compared with larger metros. The past few years, however, have exposed just how fragile that perception was. Condo prices that peaked around $310,000 in 2022 have dropped to roughly $215,000, a decline of about 31%. Inventory has surged by nearly 90% year over year in some segments, giving buyers more options while stripping sellers of leverage. At the same time, ownership costs are climbing sharply. HOA fees that once hovered near $400 per month now often reach $800, while insurance premiums for waterfront units have tripled to more than $7,000 annually. With mortgage rates near 7%, total monthly costs easily exceed $2,200 in a city where the median household income is about $60,000. Investors who once viewed Pensacola as a reliable cash flow market are struggling. Short-term rental occupancy has dropped below 50% in many complexes. Nightly rates are softening, and long-term rents cannot keep up with insurance, taxes, and association fees. New state reserve rules add another layer of pressure. Older buildings facing deferred maintenance now carry special assessments of $20,000 to $40,000 per unit. Some owners can pay, others sell at a loss, and a few walk away entirely, leaving associations to chase delinquent balances and lenders to tighten approvals. Pensacola's appeal as a stable, middle-ground market, neither as speculative as Miami nor as tourist-driven as other Gulf towns, has eroded. The sun still rises over the bay, but beneath the surface, the condo market is in turmoil. Across Florida, from Sarasota and Bradenton to Orlando, Cape Coral, Jacksonville, West Palm Beach, Tampa, Aventura, and Pensacola, the pattern repeats. Insurance costs soar, aging buildings face stricter safety rules, HOA fees and special assessments climb, borrowing costs rise, and investors pull back. This is not a temporary dip. It is a structural reset. repricing the true cost of owning a condo in Florida. If you are buying in 2026, don't rely on old marketing or sunny photos. Study reserves, insurance history, inspection reports, wages, and climate risk. Housing Watch Channel helps you see past the brochure into the real pressures shaping Florida's condo market. Subscribe and turn on notifications to track where fear creates opportunity and where the next cracks are forming. Because your home or investment is more than an address. It's a long-term bet on resilience.